Welcome to Tesla Daily News Podcast on Tuesday, March 31st, 2026. Today, we're breaking down the biggest Tesla headlines that could move Tesla, near-term delivery expectations, the robotaxi and FSD timeline, a major energy storage win in Chile, fresh analyst downside calls, and a few headline risks investors should keep on their radar. First up, all eyes on Tesla's first quarter delivery print, and the range of expectations is wide. Here's the hook. Tesla's next big stock catalyst is only days away, and the market is bracing for a potentially soft number. Context: deliveries remain the clearest, most immediate signal of demand, pricing power, and factory utilization. When deliveries come in below expectations, investors quickly start discounting lower automotive gross margin and weaker operating leverage. Details: one widely circulated view highlighted a bearish scenario around 345,000 deliveries for the quarter, versus a broader consensus near 365,000. Prediction market odds also lean to a downside skew, with implied probabilities favoring a figure below 350,000. As a comparison point, Tesla delivered 336,681 vehicles in the first quarter of 2025. Impact: if deliveries land closer to the low end of that range, the debate will shift to whether the slowdown is purely a Model Y transition hangover or a deeper demand issue in key markets. Either way, a miss tends to pressure near-term earnings estimates and can amplify volatility given how expensive the stock remains on many conventional valuation metrics. Takeaway: investors should prepare for a binary reaction. A solid beat could stabilize sentiment into April, but a miss reopens the pricing and margin narrative immediately. Second, April may matter less for what Tesla launches and more for what Tesla proves. Hook: April is shaping up as a narrative month for Tesla stock, not necessarily a fundamentals breakout month. Context: Tesla's long-term valuation still leans heavily on autonomy and software monetization, but investors have been frustrated by what many see as a slow robotaxi rollout. Details: 3 April watch items are getting repeated attention. 1. The delivery numbers we just discussed. 2. Elon Musk's stated goal that Cybercab, Tesla's dedicated robotaxi vehicle, begins volume production in April. And 3. Potential supervised full self-driving approval in Europe, starting with the Netherlands. Dutch authorities have indicated they're in final assessment steps. Impact: Cybercab production progress lowers execution risk, but it does not automatically create revenue without regulatory green lights. And on FSD, a Netherlands approval could provide a path to broader European acceptance, either EU-wide or country by country, which would matter for Tesla's competitiveness in a region where the company has been under pressure. Takeaway: April headlines can move Tesla, but investors should separate production starts from commercial deployment at scale. Regulation is still the gating factor. Third, competition remains the core gravity pulling on Tesla's auto story, especially from BYD. Hook: Tesla is still the benchmark EV brand, but BYD's volume and technology cadence are forcing investors to recheck Tesla's moat. Context: the competitive landscape has shifted toward regional champions, with China as the biggest battleground. Pricing pressure and rapid iteration are now table stakes. Details: Tesla produced about 1,650,000 vehicles last year, with deliveries around 1,640,000, and the Model 3 and Model Y still doing most of the heavy lifting. BYD, meanwhile, produced about 2,220,000 passenger EVs and delivered about 2,260,000, up roughly the high 20% year-over-year. BYD has also been touting fast charging advances, including charging from roughly 20% to the high 90s in under about 12 minutes under certain conditions. Impact: higher BYD volume, plus aggressive feature pace, increases pricing pressure globally and raises the bar for Tesla's next mass-market product cycle. For Tesla valuation, the risk is that the market continues to price Tesla as a dominant growth auto and software hybrid, while the auto side looks increasingly like a tougher, more competitive industry. Takeaway: Tesla doesn't need to beat BYD everywhere, but it needs clear proof that software, autonomy, and energy can offset margin compression in EVs. Fourth, a major Wall Street bank is putting a very loud downside marker on Tesla. Hook: HSBC reiterated a reduced rating and a $131 price target, implying roughly a 60+% drop from recent trading levels. Context: this kind of call matters less because the exact target is correct, and more because it shapes the risk conversation around valuation and execution. Details: the bearish thesis centers on pressure in the core EV business and valuation. HSBC points to deliveries declining in 2025, revenue down about 3% year-over-year, and production down about 5.5%, while bulls remain focused on robot access and humanoid robotics. Impact: When high-profile banks emphasize downside scenarios, it can weigh on marginal buyers, increase short-term volatility, and make it harder for the stock to rally on incremental news. It also pushes management commentary on the next earnings call into sharper focus. Investors will want more than aspiration. They'll want timelines, regulatory strategy, and unit economics. Takeaway: if you're long Tesla, assume the market will demand clearer proof points on autonomy monetization and margin stabilization, not just big vision. Fifth, Tesla Energy quietly picked up a meaningful validation win in Chile with Megapack. Hook. Tesla's grid storage business just got another real-world deployment that reinforces its role beyond cars. Context: Tesla Energy matters because it can diversify revenue, potentially carry attractive margins at scale, and benefits from global grid instability and renewable build-out. Details: Chile's Copec Flux launched a solar plus storage project called Proyecto Cusino, about 2.9 megawatts peak of solar generation paired with roughly 12 megawatt-hours of battery storage, using 3 Tesla Megapack 2 XL units at about 3.9 megawatt-hours each. Copec Flux also became Tesla's first certified service partner in Chile, building local capability for implementation and maintenance. Impact: this supports Tesla's strategy of pairing hardware with service ecosystems, and it signals ongoing demand for utility-scale storage even as EV demand cycles. It likely won't move the stock by itself, but it reinforces the second engine thesis investors cite when arguing Tesla should not be valued like a pure automaker. Takeaway: watch for more Megapack wins and service partner announcements, because recurring service and deployment scale are what turn energy from nice growth into valuation-relevant growth. Sixth, an operational and brand risk headline out of Australia is worth noting. Hook. Police are investigating an apparent arson incident at a Tesla showroom in Parramatta, with 3 vehicles destroyed and part of the building damaged. Context: isolated incidents don't change Tesla's fundamentals, but they can influence near-term sentiment, insurance and security costs, and the broader narrative around brand polarization. Details: the fire occurred in the early hours, emergency services responded, and authorities indicated it is being treated as arson rather than a vehicle defect. Impact: headline risk can add noise around the stock, especially in a market already sensitive to deliveries, pricing, and macro volatility. Takeaway: investors should avoid overreacting to single-location incidents, but treat them as part of the broader reputational and operational risk backdrop. Seventh, a corporate governance headline in Delaware reduces legal process noise, but doesn't remove legal risk. Hook. Delaware's top chancery court judge reassigned multiple Musk-related cases after a dispute over alleged LinkedIn support activity that Musk's lawyers claimed suggested bias. Context: Delaware governance litigation matters for Tesla because it can impact board oversight narratives, fiduciary duty claims, and investor confidence around corporate controls. Details: the judge denied being biased, but reassigned 3 cases to other judges due to disproportionate media attention. The underlying cases include shareholder claims tied to Musk's conduct and Tesla board oversight. Impact: reassignment can reduce procedural controversy, but the substantive allegations remain. These cases typically don't move the stock daily, yet they can matter over time when investors weigh governance risk premium. Takeaway: governance remains part of the Tesla story, especially as Tesla's valuation depends on investors trusting long-dated execution. Let's wrap it up. Today's big themes were straightforward. Delivery uncertainty is front and center. April's autonomy and Cybercab headlines could reset the narrative. BYD remains a real competitive pressure point. Analysts are increasingly vocal about valuation risk, and Tesla Energy keeps quietly stacking credible grid storage deployments. For tomorrow, the biggest thing to watch is the countdown to Tesla's first quarter delivery release, plus any new signals on European supervised FSD approvals and Cybercab production readiness. If you got value from this episode, subscribe to Tesla Daily News Podcast for your daily Tesla investor rundown, and follow us for updates as the delivery numbers hit. Talk tomorrow.